Good day, ladies and gentlemen, and welcome to our class on Introduction to Futures. Now, please take a second and click on the subscribe button down below or hit the bell icon. I promise you we won't bother you with tons of emails. We'll only send you a message when I've uploaded a new video. So subscribing helps me support the station. And of course, please comment. It's always appreciated. So today we're going to be talking about futures trading, which includes Forex. But a lot of traders have gotten in touch with me recently, more so than in the past, asking me for a better explanation of futures. Because most of us are trading CFDs. And a CFD will allow you to trade a CFD for corn or for coffee or for oil. But CFD tradings are usually in the current month or the spot market as opposed to futures trading. But a lot of people out there mix up the term futures and commodities trading. Okay, so everybody who has been asking me for a bit of information, so I'm going to share it with you today. Futures are exchange traded derivatives that bind a trader into buying or selling an underlying asset at a specific price at a specific future date, hence futures. They work in much the same way as contracts for difference because traders take positions on future prices based on today's price point. If prices rise in the futures price will rise, and so the instrument can be resold and executed on the expiry date in order to reap maximum profits. Futures are complicated somewhat by the rigidity they introduce into the equation: expiration dates, set quantities, stricter rules, and enforcement as compared to CFDs. Now, the futures market are, however, almost entirely transparent, tracking the underlying market more closely than any CFD broker will. Furthermore, many CFD brokers use the futures market as the basis for setting their price on their contracts, only to further handicap traders against the most likely outcomes. This effectively means that more price honesty, publicly traded futures are the way to go in preference to CFDs if you're looking for large investments. CFDs are a lot less complex, have lower costs, and are easier to understand. Now, futures trading is a form of investment which involves speculating on the price of a commodity going up or down in the future. Now, we use two words here that are important: speculating, because very rarely in the futures market are actual deliveries ever made. Okay, most of the futures market are commodities. You can trade. There's currency futures, there's stock futures, there's commodity futures, and there's indices futures. But commodities are what we more generally perceive. And what are commodities? They're things we use in our everyday life: corn, lumber, gold, cotton. And they're things that we consume or use up. Okay, we can have copper, we can have coffee, we can have even electricity is sold as a futures exchange under a commodity. Today they even sell salmon. The commodities market is larger and larger and larger and larger. All these commodities and dozens more are traded between hundreds of thousands of investors every day all over the world. They are all trying to make a profit by buying a commodity at a low price and selling at a higher price. Futures trading is mainly speculative paper investing. It is rare for investors to actually hold the physical commodity, just a piece of paper known as a futures contract. Now, let's explain that. Okay. We have lots of big speculators that are consumers. For instance, Kellogg, the breakfast company people, they need wheat and oats coming to their factories and their plants every day. Millions of bushels. And they're not in the business of dealing with price fluctuation. They're in the business of making cereal and delivering it at set price to a wholesaler and then on to a retailer. Okay. They're not in the game of speculating. So they want to secure their cost of their raw materials. They do that by going into the futures market and buying wheat for delivery in August. They buy wheat for delivery in September. They buy wheat for delivery in October. And they buy specifically the amounts that they would need to consume those months. Now, they're buying futures contracts. Okay, they're buying paper because they can't take, it's February now, and they can't take delivery of August wheat till August, September's wheat till September. Now, the value of wheat would be different in August and September than it is in February, which is the spot market, because we have a whole, say, hypothetically, a growing season in front of it. We could have a very big, successful growing season, so the price of the commodity could be down. Or we could have horrible storms. We could have coronavirus. We could have other things that reduce the production, and the price of wheat could be very high in August, September, October. Now, Kellogg doesn't want this to happen. So what they do is they buy a futures contract for August for 1 million bushels of wheat to be delivered in August at this specified price. And the price has been adjusted for what the market thinks the price of wheat will be in August. Nobody knows because August is far away. Now, Kellogg says this is fine because wheat is $9 a bushel. This is what I'm willing to pay for, and I need it always at my factory. Now, come August, Kellogg's isn't going to get delivery on their futures contracts. They're going to close their futures contracts at the price of the current wheat. So say wheat is now at $10 a bushel. Okay. So Kellogg will sell their contracts at $1 more than they bought them for, and they would have made $1 profit per bushel. Except Kellogg needs the physical delivery in August of the 1 million barrels, 1 million bushels. So they have to then go into the spot market, the real market, and buy 1 million barrels or 1 million bushels of wheat. They do this at $10 a bushel because that's the going price. So it's now $1 more than they were willing to pay. But they made $1 in their futures contract, so they net out getting their wheat at what they need at always at $9 a bushel. Okay? And they buy wheat month after month after month. Now the price of each month's contract speculates or is slightly different depending on how much wheat we consume, how much consumption we have estimated, how much the USDA says we have in wheats and oats, how good the harvest is, what the economical factors are. And this is put forward in the contract, or how the price is derived. So it is paper investing. Very rarely does anybody actually in the futures market take physical delivery. So same thing with stock. If you think Apple is going to be up to 144, hypothetically, I have no idea what Apple's trading at, to 144, Apple today is at 141, okay, you could actually go in the market and buy a futures contract on Apple to be able to buy 100 shares at a specified price in August. Now, if that August price is higher, you can sell your options and take that profit. If the August price is lower, you could force the delivery of those shares, or you could go into the share market, the stock exchange, buy the shares at the lower cost, sell your things, and offset your prices. But this is all speculation. So stock futures are derivative contracts that give you the power to buy and sell. See, and options is the only place in stock that you can sell, okay, ahead of time. You can't go short in a real stock market. CFDs you can go short. Gives you the power to buy or sell a set of stocks at a fixed price by a certain date. Once you buy the contract, you're obligated to uphold the terms of that contract. So let me show you, maybe this will help you if I show you on a chart. Okay. We're looking at my just teaching chart, the Euro US dollar. So let's get rid of the Euro US dollar. And you notice that here it gives me a choice of all the assets, and I click on futures. So I'm going to go click on crude oil futures. Okay. And what you see, it opens up crude oil 1, crude oil 2, crude oil June 2020, crude oil July 2020, August 2020, September 2020, October 2020, November 20. I can buy any one of those contracts or sell any one of those contracts at a future price. So we click on here real quickly and see. Okay, so let's go over to commodities. Let's click on crude oil. Sorry about that. Let's click on crude oil. West Texas crude oil. And crude oil is currently trading at 32, say 50. Okay. Say 32.95 at the moment. If we go into the futures market, and look at crude oil futures and say we want it for September of next year. Now, crude oil seasonality affects crude oil because driving season is over the summer while people are on vacation. Now, this year is a little bit strange, but we consume more gasoline and there's more jet fuel consumed in the summer from vacation. So therefore, there's a bigger demand for crude oil to make these. Okay. Also, air conditioning uses an energy product. So we have seasonality. So things are adjusted for seasonality. But if we were to... Okay, why isn't this giving me a reading? Okay, so we can look here. Oh, this is crude oil futures and Indian currency. I don't even know what it is. Okay, but crude oil futures for the future would have a slightly different price because of what the market expects it to be in the future. So let's try something a little bit easier to see. Let's take a look at gold futures. No, we don't want to. Let's take a look at. I need something that the market is open currently. Let's take a look at Japanese yen futures. I need something. The charts are also working properly. Okay, so the Japanese yen is currently trading at 0.0928. If we were to look at the Japanese in Forex, and let's go to the USD JPY, and we can see currently it's trading for 109.157. So we're expecting the yen to fall between now and then. So you can buy it cheaper in the future, but it really depends on what the price is in the future. Okay. Now, to be uninitiated, the term contract can be a little off-putting, but it is mainly used because, like a contract, a futures investment has an expiration date. A futures contract is set by the exchange. It's not a contract that you negotiate. It is to be made by the exchange so that everything is standardized. When you buy West Texas crude oil for July delivery, everybody buying and selling it are buying the same exact specifications so that you're not ending up with cheap crude oil that you don't realize and somebody else is ending up with good crude oil. Now, the expirations vary between commodities, and you have to choose which contract fits your market objective. For example, today is June 30th, and you think gold will rise in price until mid-August. The gold contracts available are February, April, June, August, and October, and December. As it is the end of June, this contract has already expired. You would probably choose the August or the October gold contract. The nearer to expiration contracts are usually more liquid. There are more traders trading them. Therefore, prices are more true and less likely to jump from one extreme to the other. But if you thought that the price of gold would rise until September, you would want to choose a contract further out, say, since October, since the September contract doesn't exist for gold. Neither is there a limit on the number of contracts that you can trade. All future contracts are standardized in that they all hold a specified amount and quality of the commodity. Now, before futures trading came about, any producer of a commodity found himself at the mercy of a dealer when it came to selling his product. The system needed to be legalized in order that a specified amount and quality of a product could be traded between producer and dealer at a specified date. Contracts were drawn up between two parties specifying a certain amount and quality of the commodity that would be delivered in that particular month. Now remember, commodities or all futures are traded through exchanges. So they are all regulated and licensed and monitored. So it didn't take long for a businessman to realize the lucrative investment opportunities available in these markets. Hence, we ended up with tons of speculators. The speculators are the ones that are driving the price of the markets up and down and taking profit in the middle while doing nothing. So we talked about Kellogg's or General Mills who needed the wheat to their plant. They're called hedgers because a hedger is a producer of the commodity who trades a futures contract to protect himself from future price changes of his product. So he can either be a manufacturer or a farmer or a consumer. These are people who actually, say, touch the physical goods. Even when we get out of commodities, a futures index or a stock future, okay, the hedgers are people that are in the industry. Say, for instance, you have to deliver 1,000 shares of Apple to a client on April the 1st. Okay, you're now in December. Okay, you've already made a deal with him for $144 a share. Well, you think you can buy it at sometime closer when it dips down at 142 a share and make yourself $2 a share. Okay, the person taking the physical delivery and the person owning the actual Apple shares are the hedgers, where you're the speculator. So other hedgers of futures contracts include banks, insurance companies, and pension fund companies who use futures to hedge against any fluctuation in the cash price of their products at future dates. Speculators include independent floor traders and private investors. Usually, they don't have any connection with the cash commodity and simply try to make a profit between buying a futures contract and selling a futures contract, or the opposite. In other words, they invest in futures the same way you might invest in a stock or shares, by buying at a low price and selling at a high, or selling at a high price and buying at a low. But they're looking for very specific dates. Hence, if you're trading CFDs, it's a lot easier because you don't have to worry about the future date markets. It's only the current price and you can keep those CFDs open. Now, what are the advantages of futures trading? You have transfer of risk. You have indication of future market trends like supply and demand. You have margin trading. It gives some idea about future stocks and indices prices and commodities prices. Futures are derivative products whose value depends largely on the price of the underlying stock or index. However, the pricing is not that direct. There remains a difference between the price of the underlying asset in the cash segment and in the derivative segment. The difference can be understood through two simple pricing models of futures contracts, and these will allow you to estimate how the price of a stock future index contract can be. The primary purpose of the future market is to allow those who wish to manage price risk and transfer that risk to others who are willing to take it. The speculators take on the risk, although they really want to take on the profit. They do take on the risk. The hedger, to give you another example, back in 1990s, American Airlines was in financial trouble. Now, maybe it was the early 2000s. You can look it up if you want in the newspapers. Okay. Now, airline companies always bought all of their jet fuel in the futures market because they needed their jet fuel to be at the lowest price or stabilized price all the time. And they can't deal with the craziness of the pricing, especially of the energy or the oil market. So all the airlines bought futures contracts for the price of their jet fuel. Now, when American Airlines was in a lot of trouble, it happened to be that the jet fuel price was sky high. Their options on future jet fuel consumption had a lot of value or profit built into it. So they sold those futures and booked that profit, which is something they've never done before. And that offset some of their losses, so they look better to the stock market, they look better to their investors, they look better in their profit and loss statements. And they readjusted everything in the future for a higher price of jet fuel to adjust for their future expenses. Problem was, jet fuel skyrocketed over the next few months and next year, and American Airlines was having to buy it at a much higher price because they had sold all of their options, while all the other airlines were able to drop their prices because even though the price of jet fuel had gone sky high, they still had their options. American Airlines ended up losing more money on current jet fuel than they had made profit on their options. And so eventually most of the board of directors and the people involved in this whole, it wasn't a scam, but it was a sham, were terminated. Now, speculators assume the price risk that the hedgers try to avoid in return for possibility of profits. I'll take some risk, but I want a chance of making profit. They have no commercial interest in the underlying commodities or indices or stocks, and are motivated purely by potential for profits. Now, futures are a highly leveraged instrument. That's one of the advantages that futures always had, is you could be leveraged in the market. You could buy it, and leverage is controlled by the regulator, and I don't even know what every industry and every commodity has a different, but they're usually around 10% you pay 10% of the margin cost. So what it meant was, and that wasn't a cost to you, it was a down payment. So what it meant was American Airlines sold all these futures for a huge amount of money, and they only had a 10% investment, so the profit was huge. In a cash sense, not in a profit and loss sense, but in a cash sense. In other words, an investor can trade a much larger amount of a commodity than if he bought it outright. So if he has predicted the market movement correctly, his profits will be multiplied tenfold. This is an excellent return to buying the physical commodity like gold bars, coins, and mining stocks. Now, it wasn't until recently, being, since 2010, say, that you could buy an individual trader could take advantage of other types of leverage. Now, CFDs offer mega leverage. Cryptocurrencies offer leverage. You can now buy through a CFD format stocks. Some stockbrokers will now offer you leverage. Okay. But it was only the big speculators and the big hedgers that could get the margin. Margin required to hold futures contracts is not a down payment, but a form of a security bond. The market goes against the trader's position, he may lose some, all, or possibly more than the margin he has put up. But if the market goes with the trader's position, he makes profit and gets his margin back. So there are many advantages to trading futures. But the thing you have to remember is a futures contract expires. So you have a date racing towards you. You can roll those dates over, but you have to do certain things to do that. So you're fighting that one problem. Okay. And since CFDs and futures both offer you leverage, you've got that problem out of the way. And the rigidity of the contracts. For instance, crude oil is 5,000 barrels of crude oil. Okay. You can buy a mini lot, which will give you half of that, but that's between you and your broker. But the contract is for 5,000 barrels. For orange juice, I think it's 40,000 gallons of orange juice. Where when in CFD format, you don't have the rigidity of the rules of the exchange and the standardized contracts. So there are many differences between the two, but a lot of similarities which have confused traders. Okay. So you have to remember that futures are traded on exchanges. They are regulated. They are licensed. Okay. They are standardized contracts that every trader around the globe is trading on the same exact contract. They have a rigid contract amount and they have a very rigid expiration date. Okay. So there's advantages and disadvantages. Both offer leverage. Okay. You can place a stop loss order on CFDs as well as futures contracts. But if you have a limited amount of capital to invest, you probably can't afford to trade the larger contracts like NASDAQ or S&P 500, as a slight percentage move could be worth thousands of dollars. But there are still plenty of smaller, less expensive contracts you can trade. Beginners need to establish if they can afford to trade the commodity in a futures contract as opposed to a CFD contract. Contracts for difference and futures are often a point of confusion for new traders because in essence they seem to be reasonably similar products. Of course, both are derivatives and both provide much the same leverage benefits that are common across derivatives generally. However, that's not to say there are instances where futures might be more suitable than CFDs and vice versa. Whereas futures are usually traded on exchange and CFDs are more commonly traded directly with brokers, the main distinction lies in the liquidity and the financing of both instruments, with CFD orders being more readily filled in practice and having lower barriers to entry than futures contracts as a rule. Futures are bought for much the same reason as CFDs. Futures traders are interested in investing with an eye on future prices, with a view of settling on the difference in the price between when the position was entered and when it was exited. So the major distinction lies in the technical difference between the two instruments. Futures are traded on exchanges, which means market established prices, versus broker established prices with CFDs. This guarantees that there's more price integrity when trading futures as compared to CFDs, although that comes with various restrictions of futures contracts over CFDs. In its simplest form, it's perhaps easy to think of futures are being a more structured and less flexible version of a CFD, delivering many of the similar benefits in practice. The nice thing about CFDs is you can buy a much smaller amount. You can buy 10 barrels of oil. You can buy 10 shares of stock. You can buy one part of, you can buy $100 worth of the NASDAQ. You can't do that in the futures market. So there are some things to think about. Today it is a little bit confusing, but CFDs are more the way to go if you are the average speculator trader. So thank you very much for joining us. And remember, please subscribe. Thanks. Bye now.